My name is Ian Anderson and I'm the fund manager of the Nedgroup Investments Property Fund. Today I'm going to be talking about the performance of the fund during the fourth quarter and probably looking forward into what is going to happen in 2024. The fourth quarter of 2023 was an exceptionally good year, a good quarter for markets generally, but specifically the listed property sector. In South Africa, the FTSE JSE SAPI index was up 16.5%. Unfortunately, the fund wasn't able to deliver the same level of return as the leaders or the leadership of that SAPI index was actually quite narrow. And I'm going to talk a little bit more about that later on in the presentation. For the year as a whole, the fund also underperformed the benchmark somewhat. But you can see over the last 3 years, the fund has been able to outperform both the peer group and its benchmark. And that coincides with the time when we adopted a more thematic approach to our portfolio construction, focusing on those aspects of the property market in South Africa that we believed would generate high returns for investors in the longer term. Property types that were relevant, not necessarily perceived quality. Things like neighborhood and convenience retail, self-storage, warehousing. We also have a geographic focus in the Western Cape. And again, I'll speak to that in a little bit more detail in later slides. Breaking down the fourth quarter performance, as I mentioned already, the fund did underperform both the market and the peer group. I've also mentioned the fact that those market returns were driven by a very narrow subsector of the market, specifically the heavyweights like Growthpoint, Redefine, and then also the Rand hedges like NEPI, because the Rand was also weak during that quarter. Our positions in Accelerate, Delta and Grit did detract from performance, but we do have very large overweight positions in businesses like Fairvest, which is our exposure to convenience neighborhood retail, as well as Spear, which is a focus on the Western Cape. Both of those businesses did make a significant positive performance to both absolute or contribution to both absolute and relative performance. The chart that you can see now shows just how dramatic some of the performances were by those big industry heavyweights. Lighthouse was the best performer in the fourth quarter. It is one of the smaller businesses, but it did generate a return of 36.1%. But you can see just how substantial the returns were from the likes of NEPI, Growthpoint and Redefine. Combined, they make up more than 50% of the value of the SAPI index. And in fact, their contribution to the total return for the quarter was close to 10%. You can see the performance of both Spear and Fairvest were good over the quarter. And unfortunately, though, one of our other big positions, Dipula, didn't do quite as well as the rest of the market. If we look at the performance over a slightly longer period, so not just looking at the fourth quarter in isolation, but looking at the first quarter, second quarter, and third quarter, you can see just how much listed property struggled throughout 2023 until we got to the point in November when it became obvious that the Fed was going to pivot, or it became more reasonable to expect that the Fed was going to pivot in 2024. We saw a substantial reduction in the risk-free rate in the United States. In other words, the US 10-year Treasury yield dropped by 100 basis points over that quarter. And so suddenly you saw this massive spike in prices, delivering a very strong return in the fourth quarter. But prior to that, things had actually been quite tough for listed property as a result of rising, or the prospect of rising interest rates, and specifically the fact that US 10-year Treasury yield went from around 3% or 3.5% at the beginning of the year to almost 5% by the time we got to October. But the fact that you had this pivot, or the fact that the market expected the Fed to pivot, drove returns in that fourth quarter. And we anticipate that momentum will be continued in both the first quarter of this year, but also throughout 2024. Obviously, as we get closer towards the end of the year, focus will move away from the Fed, probably focusing on the US elections. In terms of income returns, the income return for the year was 8.6%, which was lower than what we had anticipated, but most of that was for technical reasons. The fact that Endloo Place was acquired by SA Corporate and then didn't pay us a dividend as part of that transaction. Also, the NEPI dividend that we received, it wasn't classified as a dividend, it was classified as a return of capital, and as a result of that, we weren't able to distribute it to our unit holders. We do anticipate, and I'll chat to it a little later, later in one of the other slides, we do anticipate a strong recovery in distributions, and we anticipate an income return net of fees of around 10% for 2024. In terms of current fund positioning, not much has changed here. We have reduced our exposure to South Africa. I think the last time that I communicated with the marketplace, we were sitting at close to 78% South African exposure. We have got a little bit more constructive on Eastern Europe, and specifically NEPI in Eastern Europe, but we are still very nervous about the fact that many of those businesses need to refinance a massive amount of debt that was taken out when interest rates were at 1% and 2%. If that debt was to be refinanced today, the interest that would be charged on it would be closer to 5% and 6%, and that has a meaningful impact and negative impact on the cash flows of many of these businesses. Within South Africa, where we do have the bulk of our exposure, we do prefer the Western Cape. We have significant exposure to the Western Cape through businesses like Spear, and we have very little exposure, or as little as we can get, to Gauteng, and especially Sandton offices being our least preferred sector at the moment. In terms of property type exposure, we continue to favour convenience and neighbourhood retail, so we are underweight retail. In totality, the market weight is around 60% and we're under 50%, but the bulk of our retail exposure is to convenience and neighbourhood shopping centres, mainly in rural areas and townships, where we continue to see very strong footfall and very strong increases in turnover for tenants, which should translate into higher rentals down the line. In complete contrast to that, the market exposure for retail is predominantly in very, very large shopping centres, where there continues to still be a significant amount of strain. The one area where we have reduced exposure, and it wasn't something that we did intentionally, but as a result of corporate action, our residential and self-storage exposure has gone from around 19% to just under 12%, and that was as a result of SA Corporate's acquisition of Indlu Place. We do own SA Corporate, and so we haven't lost all of that exposure, but as I've mentioned, it has reduced from around 19% to 12%. We did incredibly well out of that position over the last year, as SA Corporate's the price that SA Corporate paid was around 30 to 40% above where the market price was at the time of the announcement. We look forward to 2024. As I've already mentioned, distributions for the fund are expected to grow in excess of 10% this year. And that's mainly as a result of that artificially low base that was created in 2023. There are still a number of companies in our universe that are not paying dividends or are paying less dividends that they have in the past. They're retaining a lot of capital. Some of these businesses are still trying to shore up their balance sheets. They obviously need the cash that they are generating from the rents that they're receiving in order to prop up their portfolios, or not necessarily prop them up, but certainly do things with those properties in order to attract new tenants into those properties. So payout ratios in the sector remain around 85 to 90%. We do anticipate that some of those dividend payout ratios will start to increase, and we'll get closer to the 90-95%. That should provide some dividend growth for the sector over the next 2 to 3 years. As a result of the very strong capital growth that we've just received in the fourth quarter, and we have had to revise some of the forecasts for this year downwards because of the fact that interest rates are high, and at least in South Africa are expected to remain higher for longer. The forward income yield on the fund is now just above 10%. Now, that is still very comparable to what you would get from a money market fund today or a bond fund. Importantly, though, we are now starting to see evidence that we should get some distribution or dividend growth over the next 2 to 3 years. Some of the reasons for that is we are definitely experiencing less load shedding. The severity of the load shedding is less than it was a year ago. Cast your minds back to December 2022 and January 2023. We had stage 6 load shedding pretty much every single day. Now we're sitting at stage 1 and stage 2. That has a meaningful impact and positive impact on the retailers, on office occupiers, and then obviously for their landlords. Also importantly, even though interest rates may stay higher for longer here in South Africa, we do anticipate that central banks globally should start cutting interest rates in 2024. At the moment, it looks as though the US Federal Reserve is likely to be the first central bank to start cutting interest rates. There's about an 80% probability that they'll cut as early as March of this year. So that means already by the end of the first quarter, we should get strong evidence that interest rates are coming down. That's always been extremely positive for property, and especially listed property and South African listed property. So a declining interest rate environment it usually translates into very strong capital growth. Clearly, we've already seen some of that in the fourth quarter of last year, but we expect that momentum to be maintained throughout 2024. As I did mention, though, by the time we get to the end of the year, focus will shift from what central banks are doing with interest rates to what the US elections are going to bring. And, at the moment, Trump certainly looks like he's going to be the candidate for the Republican Party. A Trump versus Biden rematch is definitely on the cards. It does, however, appear that the Democrats have done quite a bit of work in the interim. And I think at this stage, most people anticipate that the Democrats should retain the presidency at least, although there might be some shuffling in other areas of government. So that will be the focus probably in the second half of the year, but the first half I think will be driven by this interest rate outlook and the fact that interest rates are coming off and therefore be very positive for listed property. I think it's also worth pointing out that from a valuation standpoint today, there is still significant value in the sector. Importantly now, because of what's happened in the last quarter or so, a lot of that value is now sitting in companies that are not in most of the major indices. However, they do make up a significant portion of the Nedgroup Investments Property Fund. Thank you.